Hello, my name is Tursun and this is my presentation for final exam, Fundamentals of Finance, Finance 300 class, Unlocking Alternative Investment Potential, Navigating the World of Hedge Funds. So, the outline of the presentation. Brief introduction. What are hedge funds? How do hedge funds operate? What are hedge funds different from private equity and private debt? We will look at four specific terms, how hedge funds are different from them. Then we'll talk about the evolution of hedge funds, the timeline, how they evolved, and what are they now. Then we'll talk about benefits of investing in hedge funds, then managing risk and return, and finally, conclusion. Investing has evolved significantly over the years, and with this evolution comes the emergence of alternative strategies that go beyond traditional stocks, bonds, and real estate. As we know, there are some derivatives, there is real estate, there are cryptocurrencies that can be traded, and sometimes they are not even physical. You can trade real estate just by giving papers from one board to another, and by not living there, for example. So this is an asset that can be traded. And among these strategies, hedge funds stand out as powerful tool for wealth creation. But what exactly are hedge funds and how do they operate in the world of complex financial markets? We'll talk about it today. What are hedge funds? Hedge funds are privately pooled investment vehicles that employ a wide range of strategies to generate high returns for their investors. Unlike traditional investment funds like mutual funds, we know some mutual funds like Triple Q that follows Nasdaq index, SPY that follows S&P 500. Hedge funds are less regulated, giving them greater flexibility to pursue aggressive and complex strategies. So there are 5 examples of big hedge funds. Citadel with $397 billion under assets under management, then Bridgewater Associates, AQR Capital Management, D.E. Shaw, and Renaissance Technologies with $89 billion under management. How do hedge funds operate? Basically, there are some strategies such as long and short equity, buying undervalued stocks long and shorting overvalued ones. For example, some of the hedge funds, they understand that for this time, the companies that sell video games physically via DVD discs and other physical information carriers, they are not giving enough profits. And some hedge funds short sell GameStop, the market that sells video games on discs. Also, some of them started to sell short AMC theaters because they see that the movie industry is not good at this time. There are more people going to buy Netflix subscriptions, HBO subscriptions, and streaming services are now dominating in the market. So there is a place for short selling. Then they can use arbitrage techniques, exploiting price discrepancies between related securities. For example, when there started a war between Russia and Ukraine, some Russians came to my country, Kyrgyzstan, to exploit the price ranges. And for example, if their currency is selling for 100 there, for $1, and in my country, in Kyrgyzstan, rubles are selling for 90 for $1, they can exploit this 10 ruble difference to gain profit. And hedge funds also do this. There is also global macro, making large-scale investments based on economic and geopolitical trends. For example, if I know that Chinese electric vehicle industry is the major in the world, how I think, some hedge funds can think the same way and invest heavily in Chinese EV market. Then event-driven, investing based on specific events like mergers, acquisitions, or bankruptcies. We can short sell Spirit Airlines because we know that at one day they will be bankrupt. And for example, 2 weeks ago or 1 month ago, Spirit Airlines filed for bankruptcy, and hedge funds that sold short on Spirit Airlines stock named SAVE SAFE. They gained from this operation. How do hedge funds operate? Leverage. Hedge funds often use borrowed money to amplify potential returns, which also increases the risk. For example, if I have $1 million and I want to gain some money and I know the correct way, I can borrow some money and get my assets up to $10 million. So this is 100, not 100,000% leverage, 1 to 10, and this increases the risk as well as increases my return. And hedge funds also have fee structure known for the 2 and 20 model. Hedge funds typically charge 2% annual management fee and 20% performance fee on profits. For example, if I have $100,000 in my hedge fund account, they will charge me $2,000 annually. And for example, in 1 year, I'll earn $40,000. They will take 20% from those $40,000. How are hedge funds different from private equity and private debt? Let's talk about investment focus. Hedge funds focus on liquid assets like stocks, bonds, derivatives, and currencies, while private equity invests in private companies or buys out public companies to restructure and sell later at a profit. And private debt provides loans or credit to private companies as an alternative to traditional financing. Liquidity. Hedge funds offer more liquidity. Investors can often redeem investments within a shorter time frame. They are more liquid than private equity and private debt, which are illiquid investments with longer lockup periods, often 5 to 10 years. Strategy. Hedge funds use a variety of strategies, including leverage and short selling, to achieve high returns, while private equity focuses on operational improvements, acquisitions, and long-term growth, and private debt concentrates on generating steady income through interest payments. And finally, risk and return. Hedge funds higher risk and potentially higher returns depending on market conditions, while private equity and private debt have lower risk with more predictable returns and requires a long-term commitment. The evolution of hedge funds. Hedge fund principles were introduced by Alfred Winslow Jones in 1949. He focused on combining long positions with short selling to hedge risk. In current market, right now we see bull market with almost 30% stock and mutual funds raised from the beginning of the year. But when there was an uncertainty, it is good to have some long positions and some short selling positions to hedge the risk, because there is also always risk and uncertainty. In 1980s, institutional growth, emergence of major hedge funds such as Quantum Fund by George Soros. All we know his name, all we know his fund for charity. And adoption of global macro strategies and use of leverage. In 1990s, rapid expansion, introduction of quantitative strategies and computer-based trading. Computers now took the space because computers are more faster. You can program the computer model to execute the trade immediately based on some indicators. And hedge funds began targeting a broader range of assets like derivatives and currencies. Derivatives such as futures, options, and many, many more. In 2000s, modern hedge funds shift toward multi-strategy approaches to diversify risk, advanced technology like AI and big data analytics for decision making. Computers evolved more, and there was an emergence of AI which helped to hedge funds, and also big data analytics helped to gather more data to understand more patterns and how the market can behave under certain circumstances. And finally, in 2020s, current trends, hedge funds focus more on ESG, environmental, social, and governance investing, greater transparency and investor scrutiny, growing role of hedge funds in cryptocurrency and alternative assets. For example, maybe 2 weeks ago or 1 week ago, Bitcoin took all-time high $104,000 per one Bitcoin. This is all because half year ago, some institutions proposed to create an ETF for cryptocurrency, ETF that was supported by Bitcoin, ETF that are supported by Ethereum, and also right now, Trump government and his policies are pro-crypto, which helped the cryptocurrency Bitcoin rise to more than $100,000. Benefits of investing in hedge funds. Diversification. Hedge funds invest in a wide range of assets, including stocks, bonds, and all the stuff that I mentioned before. This reduced overall portfolio risk because if you have a lot of places to keep your eggs, that means that some of them will be safe. Use of unique strategies like short selling and derivatives helps mitigate market volatility. Potential for high returns. Hedge funds aim for generating profits regardless of market conditions. They have access to alternative investments, such as futures for wheat in Ukraine. If you see that the war in Ukraine and Russia became, you can buy some futures for the current price and understand that Ukrainian wheat is going to be much more expensive. And finally, hedge funds can invest in non-traditional assets like private equity, commodities, real estate, and cryptocurrencies. Managing risk and return, diversified strategies. Hedge funds employ a mix of strategies, long-short, equity, arbitrage, and global macro to balance risk and maximize returns. Diversification across asset classes, geographies, and industries helps to reduce exposure to individual market downturns. For example, if I have $2,000 under my management to trade, to invest, some hedge funds like Citadel have almost $400 billion under management. Their scale of geographies, countries they invest, and the scale of the assets they control. They can perform way better than me because they have more information, they have all of the technologies. They also use hedging techniques. They project against downside risk with short selling, derivatives, and other risk mitigation tools. Example, hedging against market volatility by shorting correlated assets. If there is volatility in Bitcoin, and I know that MicroStrategy is the company that buys Bitcoin and holds a lot of Bitcoin, which is publicly traded, and to minimize my risk, I can buy options, put options, which means short options, to the MicroStrategy and hold some Bitcoin. If Bitcoin drops, I will gain from my options. If Bitcoin rises, I will not have that much in my options and it will not damage me that way. But I have something to cover my losses. And finally, conclusion. Investment sphere is a difficult area. Consistent work with uncertainty and enemies on the different side of the market. If I'm buying, there will be always someone who's selling. And if I'm buying, I think that I'm right. And if somebody is selling, he will think that he is right. Financial operations with short-term assets are mostly recognized as zero-sum game. And the institutions, such as hedge funds, they have a lot of information. And I believe to perform better in such markets, we need to follow those big institutions that have $400 billion under their management. Hedge funds are dynamic and versatile investment vehicles that offer unique opportunities for generating high returns and managing risk. By leveraging advanced strategies, professional expertise, and access to alternative assets, hedge funds have evolved into a key player in modern financial markets. Almost every beginner investor has to know what are hedge funds and how they operate. Here are my references, and thank you. See you tomorrow, Tuesday, on Finance Exam Day.